Hello, and welcome to our webinar titled, My Will, It's Not About Me. My name is Susan Haefner from Hope Ministries. I want to thank you for joining us today. We're happy to be able to offer this valuable education for our wonderful partners in this ministry. With your partnership, we've been able to serve homeless, hungry, abused, and/or addicted people in Central Iowa for 104 years as a 100% privately funded, Christ-centered nonprofit. Talking about wills for many people can be a difficult topic, which is probably why such a high percentage of people don't have a will, or if they do have one, it's out of date. In reality, it's an opportunity to leave a legacy, because it's not about the money, it's about the message you want to leave to the next generation. We've invited a leading expert to facilitate our discussion today. I'd like to introduce Johnne Syverson, Executive Director of Charitable Giving Resource Center and a Senior Partner with Syverson Strege. So without further ado, I'll turn it over to you, Johnne. Thank you for leading our webinar today.
Well, thank you, Sue. It's just a privilege to be here today to share some insights into this topic of will planning and building your legacy for yourself and your family and your community. That's what we're all about here today. So let's see if we can get started. And by the way, you have in your dialog box, if you have a question, you can just submit your question, and we'll try and answer those either as we go or at the end. And you can't do it verbally, but you can just type it in the question box there in your control panel on your GoToWebinar. So with that, we will, oops, something's not going right here. How come this isn't going? Okay. There we go. So I thought I'd start out with the scripture verse that in Deuteronomy says, every man shall give as he is able, according to the blessing of the Lord, your God, which he has given you. So basically, everything we have comes from the Lord. And so it's really up to us to then bless others with what we have been given. So giving is just a vital part of the Christian's life. But here are the outcomes of our the webinar today that I'd like to have for you, and that's I want to help you know how to build your financial estate plan so you can have a lasting impact for yourself, your family, and the community in which you live. And so we're going to use kind of a building analogy, like you're going to build a house. And then while we're at it, I'm going to help you provide a better understanding of the benefits of certain charitable gift instruments that kind of correlate with your will and your estate planning. These are instruments that are found in the tax code, some of which can actually provide income back to you, and you don't have to die to beat it. Isn't that a good deal? Well, we'll get into that. So what we find is that as far as kind of your personal financial estate planning, different stages of life call for different goals for different people. So if you're in your 20s, you might need some basic estate documents, will and a power of attorney, but you have a high need for maybe life insurance and disability insurance to protect your future income, which you're just starting to earn. If you're in your 30s and 40s, you still need to do some basic planning, but you got to make sure you've cared for your dependents. Plus, maybe start building up some rainy day funds and have some retirement savings going, which is not easy when you're still raising children. If you're in your 50s, then it's time to maybe update those wills that you created 5 or 10 or maybe 20 years ago. Perhaps start thinking about some trusts. We'll talk about trusts today. And maybe start thinking about, what if I need long-term care when I'm in my twilight years? That would be a time to start thinking about that, at least in your 50s. And if you're in your 60s and above, well, that's when you get into a little bit more advanced estate planning, which we'll get into some of that today. And you might be also thinking about retirement plan distribution planning when you're no longer drawing a paycheck. We really won't be touching on that today. And then, after retirement, you got to continually update and monitor what you're going to leave and to whom and how. And so this whole planning process is not a one and done type of a transaction. It's an ongoing process. 1 Timothy 3:5, it says, if a person does not know how to manage their own household, how will they care for the church of God? Well, it's important to have this knowledge so that you know how to care for your household, and so that your household and your family does not become a burden on the church or on public welfare. All good planning starts with setting clear goals, and sometimes it's very difficult to set those goals. You might need some help in setting those goals. But here's some common planning goals that I found over the years that are helpful for people. If you're younger, you're having a goal to accumulate a certain amount of assets and build that nest egg up for the future. You want to maybe have a goal to build a certain standard of living and maintain that in retirement years. You know, it's interesting, people will often say, if I'm 40 or 50, well, when I retire, I won't need as much to live on. Well, I'm here to tell you that I deal with a lot of retirees, and they all need as much the day after they retire as they did the day before. So keep that in mind when you're setting your retirement goals. Some other goals are to convert some tax dollars to charitable causes. You know, the tax law provides mechanisms in which we can redirect government philanthropy into private philanthropy. You just have to know how to work it, and we're going to tell you some of those tools today. And then another goal would be maybe I want to transfer assets to my family or other beneficiaries either now or particularly after I'm gone. That's really part of the estate planning process. Who's going to get what and when and how after I'm gone. And then finally, another common planning goal is what kind of a lasting impact I want to leave for my favorite causes and the community in which I live. And sometimes people aren't thinking about that as early as they should. And when you start thinking about that earlier in your planning, it allows you to open up some new doors and new drawers in that planning toolbox and possibly take advantage of some tools that you weren't even aware were in there. In Proverbs 24, it says, through wisdom, a house is built, and by understanding, it is established. And by knowledge, the rooms will be filled with all precious and pleasant riches. So we're going to help develop some knowledge that you'll turn into wisdom today. Hopefully, that'll be our goal. Now, you know, it's okay not to plan. The government will do it for you if you don't do it for yourself. So does it matter if it's the state or the federal government to you? Well, you lose control either way. I think most of us would like to take control of our own planning. But without proper planning, your goals and objectives may not be achieved. Planning really pays. I've seen it over and over and over again in my career. Here's some roadblocks to achieving some of those goals that you may have set out. Poor health can get in the way, especially if poor health occurs a little earlier than life. Premature death is a problem. It's pretty hard to complete your goals if you're not breathing. Paying taxes and maybe paying unexpected taxes or taxes at a higher rate than you had planned on can kind of divert some of your resources. The probate process, we'll talk a little bit more about that today. That's if the person passes away, they don't have things arranged a certain way, they have to go through a probate process so that their assets can be distributed and retitled to their heirs. The biggest roadblock I found to achieving people's goals is procrastination, particularly in this area of financial and estate planning and will planning. It's just easier not to think about it. I'll do it next week. I'll do it next year. And all I would tell you is I found that the plans you have in place today are the plans that your family may have to live with if you don't make it till tomorrow. So procrastination is a severe impediment to achieving your goals. So if we think about building your financial and estate planning house, what are you going to start with? Well, you got to have a good foundation no matter what you're building. And we find that a place to start is kind of a lifetime thing called getting your medical power of attorney and living will set up. So medical power of attorney, this doesn't have to do with dying. This has to do with being ill when you're living. It allows you to designate a person to make medical decisions for you when you can't. You become incapacitated, and the doc says, well, we need to do surgery or we need to do a transplant, and the person's unconscious. Who would be designated to make your decisions for you? And this document covers both emergency situations and even routine medical situations. It also provides for a release of what's called the HIPAA information. That's your medical history. All the Privacy Act business has come about over the last number of years state that unless you can present the document to the medical people that allows you to access your loved one's medical history, they can't give it to you. So how in the world are you supposed to make a good medical decision for your ill loved one when you can't get the information? Well, proper medical power of attorney documents provide for such a release, but you have to have them signed when you're healthy. Other issues to be addressed in your medical power of attorney is who do you want to make decisions for you in the event that you're incapacitated. In my case, I've got a daughter that actually went to nursing school. She's not nursing, but she knows something about medicine anyway. That helps. And so for medical, I've designated her. Now, financial, that's not her deal. I've designated someone else to make financial decisions for me if I'm incapacitated. So to think about who do you want to make decisions for you in the event that you're incapacitated. When would you want it to be effective? Would it be only if you're unconscious? Would it be only if you're out of sorts? Or would it be just if you want somebody to come alongside you? How is that right triggered? And that's all in the document that you draft. And then are there any limits on this agent that you've selected to act on your behalf as far as their powers to make directives regarding your health? And any other special directives to include, even as to, what kind of treatment you would or would not want to have in certain circumstances. So sometimes these documents are 1 page long. I've seen some that are 6 or 8 pages long, and it's normally best to have an attorney get involved with that. Now, I'm not an attorney, by the way. I'm a certified financial planner. I'm an accredited estate planner, and I'm a chartered advisor in philanthropy. But we work over the years and have worked with lots of attorneys that I see a lot of these documents come through, and they are all, I can just tell you, they're from 1 page to 6 or 8 pages, depending on who's doing them. Kind of a corollary document is something called a living will. Now, a living will comes into play when you're terminal, when the medical people say, you're not going to make it. Okay? This document will say, how do I want to be treated in my last days of my life? And of course, the big Terry Schiavo, remember she was in St. Louis. She was held in kind of a comatose state for 10 years, and her husband and her parents were both fighting over, do we pull the plug or not? Well, had she had a living will, she would have been able to indicate that herself, and they would have followed it. I've got a little document here on the screen called 5 Wishes. And you can get this by going to www.agingwithdignity.org. I think they still charge about $1 for this thing. And it's a nice booklet that allows you to state your wishes as far as how you want to be treated if you're ill, and particularly how you want to be treated if you're terminal. And in fact, it includes a medical power of attorney right in it, which is effective in many states, including Iowa, but not all states. So there's a nice little tool for you. If you don't have a medical power of attorney and living will, go to agingwithdignity.org and have them send you the 5 Wishes book. It's really a great tool. Okay, so how does the healthcare power and the living will work together? Well, the healthcare power, you choose someone to help with a treatment plan when you're ill, but you're not terminal. And the living will is you choose the treatment plan ahead of time as how you want to be treated when you're incapacitated and you're terminal. See the difference? Healthcare power, you choose a person to make your choices. The living will, for the final decisions, you're stating that ahead of time in the document. Okay, well, as we continue to build our foundation, let's go to the financial power of attorney. Isn't that a cool picture there? Building with those rocks right by the ocean. Wish we were by the ocean today instead of all these snow piles. Well, financial power of attorney, sometimes they're called durable powers of attorney because we talk about that. They deal with how to, you designate someone to make financial decisions for you during your life if you're incapacitated. So they can pay your bills, make deposits, buy and sell assets. And they act in your shoes if you're not able to, but you're still living. And these powers of attorney can either go into effect immediately, or they can be circumstantial. More commonly, they call them a springing power of attorney. My power of attorney doesn't go into effect unless the doctor says I'm incapacitated. But you can have an immediate power of attorney. If I'm going to Europe for a month, which would really be nice, I may give an immediate power of attorney to my son to act on my behalf while I'm gone so he can take care of affairs back home, even if I'm not incapacitated. So there are different types of powers of attorney. The durable portion means that It does not expire if you become disabled or incapacitated. Just a general power of attorney expires if you can't act on your own. Well, what good does that do? So I'm really in favor of durable powers of attorney that are durable throughout an incapacity or disability. Important provision to look for. So you got to determine again, who would make my financial and legal decisions for me if I'm not able? When is it effective? Immediately, or only when I'm disabled? How is it triggered? Again, any limits on the powers that I'm granting to somebody? You can restrict limits, for instance, to not be able to transfer real estate, or you can allow them to transfer real estate. Any special directives from a financial and legal perspective that you might want to include. Again, these can be 1 page to 6 or 8 pages, depending on who's drafting them and how fancy you want to get. So far, so good? Now we'll get to the topic at hand, and that is the last will and testament. So in Proverbs it says, a good person leaves an inheritance to their children's children. I think you call those grandkids. I've got 9 of them. They're great. I'm going to start with them next time. They're a lot more fun than kids. They think you're wonderful. Little do they know, huh? Okay. Anyway, so biblically, we're really instructed to be planning for our future inheritance for our children. And so so you might say, well, what if I don't have a will in place and I pass away? Well, bad news. The state of Iowa will then decide where your stuff goes. It's right in the law. If you're married, it may or may not go to your spouse. If you have kids, if you have second marriages, it gets really dicey when you don't have a will that says, here's who gets my stuff when I'm gone. So here's some pretty common things that you'll find in a last will and testament. Obviously, you want to determine who gets your stuff when you die. And often if you're married, you'll leave everything to your spouse. And if you have children and you both die in a car accident, you'll leave it to the children, unless you've disowned them or unless you don't think they're responsible. You also have a chance to name an executor. An executor is a person that kind of steps into your shoes after you're gone and winds up your affairs. Their job is to, identify everything you own and gather that up and then kind of follow whatever instructions are in your will. You can also name guardians if you have minor children at home, because if you don't name guardians to take care of those children, if you're gone, then a court judge gets to name whoever he wants to be guardian of your minor children until they're of age. So that's a good reason for a young family to have a will, even if they don't have a lot of financial resources. And you can create certain types of trust. There's about 104 different types of trust. And sometimes there's a reason to create a trust in your will. Sometimes we create the trust outside the will. And all the trust does is kind of gives more direction and control over certain assets to be handled in a certain way. Maybe you have, like I have a grandchild that has Down syndrome. So she has special needs. They call it you can have a special needs trust set up that would provide her in a special way so as not to preclude her from eventually receiving government medical benefits. And if you don't do that, it might goof up her government medical benefits. So there are many reasons to insert types of trust language in a will itself. So here's a true or false question. If I have a will, then my estate avoids that legal court probate process. Wrong. The will is just a ticket that gets you into the probate court. You present the will to the probate court judge, who then says, oh, this is what this person said. Now let's gather up all the assets and I'll help you distribute it to the right people. So that's called the probate process. A lot of people will say, well, that's I'm not sure I want to go through that. Is there a way around it? It's not a bad process necessarily, but it's time consuming and there's some costs with it. You got court costs, you got attorney costs, etc. But if you're trying to avoid probate, particularly with certain assets, you can certainly do that. Give away your stuff during life. Of course, you got to keep enough to live on. But beneficiary designations do not go through probate. What would you have a beneficiary designation on? Primarily life insurance and retirement plan accounts, IRAs and 401ks and those type of things. And then you can also put a POD, payable on death designation, on a bank account or a transfer on death, TOD designation on brokerage and securities accounts. And if you've done that, then that goes around the will, around the probate process, and goes direct to whoever you designate. You just made an agreement with who's ever holding those funds or those assets that your death pass them to the person you're naming. And that's a pretty good technique, especially for smaller estates, if you're concerned about avoiding probate. Another thing that avoids probate is owning property jointly with someone else. We call it JTWROS, joint tenancy with right of survivorship. That's what that means. If my wife and I own a property, and usually it's your residence, in joint tenancy with right of survivorship, it'll say that right on the deed. And if I pass away, she instantly owns 100% of that house. Prior to that time, we both owned 100% of that house. We didn't each own a half. We both owned the whole thing. If I die, boom, she owns it instantly. She doesn't have to wait for the court to decide when she can have it. It's hers. The only problem is that if that type of ownership is then at her later passing, there's no joint tenant. And now if her will doesn't say where the house goes, then we have a problem. So those are some pretty important things to consider as you consider whether or not you want your estate to go through a probate process. Another more sophisticated device, which more and more people are using, is called a revocable living trust. It's a special trust that's created outside of a will while you're living, and you can change it. That's a very, very useful tool, and I'll get into some more detail on how you can use that. But some people will have all their assets owned by their revocable living trust, and in the event that that's adequate, then there's no reason to go to the probate court because your trust says who gets everything, and it's a legal binding document. And it does provide some privacy to the family. You know, if you go through the probate process, all your probate court records are public information. Anyone can go down, a year later and find out what you had, who got it, and then call them up and sell them some swampland in Florida. So a lot of people are moving to these revocable trusts for privacy reasons. There's really no financial or tax reason to set up a revocable trust. And of course, charitable gifts at your death go outside of probate, and you can make charitable gifts in numerous ways. A very common way is to put a bequest in your will that says, I leave 10% of my estate to the church, and 5% to Hope Ministries, and 10% to the college, etc. Those go outside of the probate process. And so in 1 Timothy it says that if anyone does not provide for their own family, especially for those of their own household, they have denied the faith and are worse than an unbeliever. We're commanded by the Scripture to do this kind of planning, folks, and it's really important. This is all part of your lifetime stewardship. And I'm told that between 60 and 70% of the U.S. population does not have a will. It's hard for me to believe that, but that's what they claim. Okay? So I think we're mandated as Christians to do this kind of planning and have made proper plans so that when we're called home, that our affairs are going to be taken care of appropriately and not put our family in a bind. Okay, so as we finish the interior of this structure, this revocable living trust came up. Let's talk about that animal. It seems kind of strange to people if they, well, I've got a will, why do I need a living trust? Well, this living trust is really broken down into 3 elements. It's revocable. You can completely change it. There's no creditor protection. If you get sued owning a living trust, your stuff is exposed to the creditor just like it was if you owned it outright. It's living. You create this during your lifetime. Sometimes they're called inter vivos trust because that's a Latin word that means during life. And it's a trust. And a trust usually has three parties. It has a grantor, the person that sets up the trust, puts the stuff in it. A trustee that manages the affairs and is responsible for it, legally responsible. And then a beneficiary of the trust is who gets either the income or the assets when the trust terminates. So those are the 3 components of any trust, including a revocable living trust. So here's how it functions. Kind of got a little diagram here. Okay, so you're the grantor in the gray circle there, and you go to the attorney and set up a trust agreement. And usually they're 15 to 20 pages long because you got to, consider every contingency that can possibly happen to you. And then you're going to name yourself normally as the trustee. You and your spouse might be the trustees of the trust during the lifetime. I've got one. That's what I've done. But then if one or both of us becomes incapacitated, I have named successor trustees that take over if I'm incapacitated, kind of like that power of attorney, only more powerful. And in the event of my passing, then the trustee is responsible for collecting my assets and distributing them to whoever had listed as the beneficiaries of my trust in the yellow circle. And so it becomes kind of, I would say, a will substitute. Now, you still need a will to pour over any assets into this trust that you may have not titled properly, because people forget to title things in their trust during their lifetime. But assuming you did everything correctly and had all of your assets titled in the name of your living trust at your death, there'd be no reason for your will to even be presented to the probate court, because it's all cut and dried. Everybody knows who gets what, and it's legally enforceable. So that's kind of the function of how a living trust could work. Okay, so how do all these pieces fit together? Well, the top tier here, you see your living trust. You're your own trustee, so during your lifetime, you're in control of everything. You don't file a separate tax return for it. Your Social Security number still is the number for the trust. You kind of ignore it until it's needed. And then your financial power of attorney, you kind of still need one of those, because, for instance, if you're incapacitated, and your investment broker says, I need to change some of your investments in your IRA. Well, your IRA cannot be owned by your living trust. So you still need to name someone to be your power of attorney to be able to deal with your stockbroker to change your investments if you're incapacitated inside of your IRA. So you still need that document, but you don't need it as much as you would have if you didn't have a living trust, because all of your assets owned by the living trust, if you become incapacitated, are governed and handled by your successor trustee. So then after death, your successor trustee has to do everything that an executor would do. Just like with your last will and testament, you name an executor with your irrevocable trust. By the way, your irrevocable trust becomes irrevocable, not able to be changed the minute you pass away. We just had a client pass away in November, and so his trust basically became irrevocable. It didn't go away, but we had to get a new federal ID number for the trust. It's going to now file its own tax return and everything, and that trust could, within the provisions, could stay in place for years and years and years, or it may just distribute all the assets out to the family 3 months from now. It's just whatever wording you put into the trust. So I want you to see how those all fit together. Okay, so you really have, I'm just going to stop there and just make sure I better look and see if anyone's raised any questions. Has anyone raised any questions? No questions. That's good. Okay, so I got to X out of that. All right, back to the matter at hand here. So tell me, it's my understanding we have 3 choices of where to leave our stuff when we pass away. And I want you to tell me if you thought of any others. What are those 3? Okay, now I'm messed up again here. Oh, there you go. Your family, the government, or your favorite nonprofits. I've been at this for 46 years, and I've never found any other place that people leave their assets after they're gone other than those 3. If you come up with a 4th, let me know. It'll be interesting. So those are the 3. Now, if you have certain types of wealth or large amounts of wealth, you have to pick 2 out of the 3. You can't just pick 1. Can't leave it all to the family and nothing to government, nothing to nonprofits. So that's where this planning comes in. And what I like to help people show is whatever was going to go to the government, if they can shift that to their favorite nonprofit, it keeps it local, and now you have more say-so over your philanthropy as far as where it goes, rather than being an involuntary philanthropist, and that's what we call a taxpayer. So here's the question. Will you choose to leave your legacy to the rest of the society through taxation and let Congress decide what to do with those funds? Or do you want to leave a gift honoring God by choosing to help your family, your favorite ministries, and His work rather than the government's work? And you have that opportunity. It's perfectly legitimate, perfectly legal, but you have to plan. Okay, so what's next? I want to introduce you to some basic tools for making charitable gifts that can have lasting impact for yourself, your family, and your community. And usually when we're talking about charitable gifts, you think of, well, I'm going to write a check. I'm going to give it to Hope Ministries or the church or the college or the hospital, and that money's gone, and they're going to do good things with it. Well, there are certain other types of tools that are in the tax code that are a little more sophisticated than that actually provide you with some lifetime benefit, as well as assisting your favorite nonprofit after you're gone. So, remember the famous show Tool Time? There's the neighbor looking over the fence. Well, here I am. I'm going to be the tool guy today. I'm just going to show you a couple tools that may be helpful to you as you do your financial and estate planning. Consider any changes or updates to your will or trust. So, two of the most commonly used charitable gift planning tools are the will bequest, putting a bequest in your will that says, at my passing, leave X percent to this charity, Y percent to that charity, and so on. And the beneficiary designation that I talked about earlier. They're very simple, and it's a way of leaving a legacy to your favorite nonprofit after you're gone. These don't provide any lifetime benefit, but without these, your favorite organizations are not going to receive anything after your passing, unless they can talk to your kids into sharing some of their inheritance with them. So the will bequest. Technically, that's a gift of personal property such as money, stocks, bonds, or real estate owned at the time of death, which is directed by your will to leave a legacy. You just put a clause in your will that says, at my death, here's what goes to which organization. For years and years, that was about the only way people took care of their legacy with their favorite nonprofits. But in more recent years, we're finding that there's some alternatives to the will bequest that are a little more exciting and actually can help you more during life. And so the will bequest, while it's low-hanging fruit, is probably not my favorite. It's not as beneficial to the donor as some others would be. But if you're going to do a will bequest, or if you already have one, you can either leave a fixed dollar amount to your favorite charities, which the law people don't like, the attorneys don't like it, because what if your estate gets, you're going to leave $10,000 to Hope Ministry and you're only worth $9,000 when you die. Now what do we do? A fixed percentage is more commonly accepted, and that's what I would recommend. A percentage of whatever my estate is, my taxable estate, my non-taxable estate, however you define your estate, can go to your favorite nonprofits, or you can even leave certain assets. You know, you can leave the lake home to a particular nonprofit, or you could leave the grandfather clock, or sometimes people leave art to art galleries as part of their bequest. The beneficiary designation that we talked about earlier, it's always attached to either a life insurance policy, an IRA, or a 401k account, and it simply does the same thing Will does. It says, who gets this stuff when I'm gone? And it's a contract between you and that insurance company or you and that financial institution, and therefore your will doesn't touch it. It has nothing to do with where those assets get distributed, because you already had a direct contract in place before you died. It's just a real easy, meaningful way to make impactful gifts to your favorite nonprofits, and sometimes it's even better for the family if you do it that way, particularly from IRA assets, because IRA assets are pre-tax assets. And if you don't pay the tax on them by pulling the dollars out during your lifetime, you leave it to your family, they get to pull the money out and they get to pay the tax on it in their bracket. It's much better to leave those type of assets to charity, and I'll show you an example of that here in a minute. So to make this kind of a change to your beneficiary designation, doesn't cost anything. Just talk to your life insurance agent or the custodian of your IRA. Just ask them for a form. Says, I'd like to leave 10% of my IRA to Hope Ministries. Boom, done. Doesn't cost anything. You send it in, you get it back, and at the end of your passing, 10% of your IRA gets sent to Hope Ministries. 90% gets sent to the kids. They get to pay tax on it. Hope Ministries doesn't pay tax on the 10% you left them. Now, what I'm recommending for beneficiary designations, however, is if you're married and have a spouse, you normally want to name the primary beneficiary to be your spouse, and then you often name the contingent beneficiary to be the portion of that is either going to go to kids or to your favorite nonprofits. So that's only after you're both gone. Otherwise, you don't have to do it that way, but if you leave money to nonprofits at the first death, the surviving spouse might not be too happy to have their inheritance cut down, especially if they need that to provide for themselves. Here's some things to remember. A beneficiary designation is revocable. You can change your mind 3 times a week. You just ask your provider for another beneficiary change form. Doesn't cost anything. and it's not affected by the will. There's no legal cost. And it allows, as I said earlier, to have all these accounts pass outside of your will. It does not go through the probate process. I mean, technically, if you had enough of your wealth in these type of assets, you could probably avoid probate just by using beneficiary designations, depending on how your wealth is structured. But just keep in mind that whatever your beneficiary designations say is not affected by what your will says. Common point that's missed by many people. I've got a couple questions for you. Let me ask you this. Let's say you're going to leave 2% of your life insurance or your IRA account to your Hope Ministries. Is that going to impact your heirs' lifestyle? Come on, be honest. They aren't going to miss a meal. And if you did that, what message are you sending to your family in doing so? I believe you're sending them the message of what was important to you, what your value system was. You cared about helping the poor and the homeless during your lifetime, and you're going to care about that even at your passing. That sends a powerful message of cheerfulness, generosity, and philanthropy to the next generation when they find out that that's how that IRA account got split. Now, hopefully, you would have shared that with them during your lifetime, and it gives you an excuse to start talking to your family about those issues by making that change in your beneficiary designation. So as a result, what you do is you just simply insert your nonprofit's name as part of the contingent beneficiary. It could be 100%, it could be 2%, it could be 50%. You can mix and match that any way you wish. It's just a matter of what you put on the beneficiary form. Again, normally if you're married, we'd have your spouse be the primary beneficiary, inject the nonprofit as the contingent beneficiary. Here's a quick example. So, you know, when you set up an IRA account, you have to list who your beneficiary is, and for many people that was 20 or 30 years ago. You know, the first IRA came into existence in 1975. I remember that. You set aside $1,500 a year, tax deducted, and grows tax deferred, and when you retire, then you're going to be in a lower bracket and you pay the tax then. That was the theory. Not everybody's in a lower bracket when they retire, but regardless. So what most people do is they name the family as the IRA beneficiary. So in this case, you can see here we've got mom and dad have a $100,000 IRA that named their family as the beneficiary, and they also have $100,000 of Microsoft stock that they paid $10,000 for 20 years ago. It really grew in value. The broker keeps telling them to sell some of that and diversify. They got too much concentration in Microsoft, but they don't want to do that because they'd have to pay capital gains tax on the difference between the $10,000 that they paid for the stock and the current value of $100,000. So they said, well, I think we'll just use that as our charitable bequest. We'll leave that to Hope Ministries. So let's see what happens when mom and dad dies. Okay, so mom and dad dies. Hope Ministries gets $100,000 of Microsoft stock. They don't have any capital gains tax to pay because they're a nonprofit, so they get to keep $100,000. The IRA, on the other hand, is payable to the family, who then gets to pay income in respect of a decedent tax. That's what IRD stands for, of $25,000 in their bracket. So the kids end up with $75,000. Hope Ministries ends up with $100,000. Is there a better way to do this? I'm glad you asked. Because if we just flip that around, and let's see, did I flip it around today? Yep. Here we go. Now we're going to change our beneficiary in our IRA to Hope Ministries. Sue, and Hope Ministries receive $100,000 at my death from my IRA. Are you going to mind that?
Not at all.
Not at all. Okay. Are you going to pay any tax on that?
No.
No. You're a tax-exempt organization. Okay, so far so good. So you're still in the same boat you were the other way I had it. Now, if I then leave my stock to my kids through my will or through a transfer on death designation, do they pay any tax? No, because the tax law says there's a step up in basis at death rule. Step up in basis at death rule that says at my death, whatever my basis was, steps up to the current market value, and if a week after the funeral, after all the flowers have been put away, all the cookies have been eaten, and all the grief has been taken care of, now the kids can sell my Microsoft stock and they get to keep the whole $100,000. Isn't that better for the family? That's just a cute little trick that's not hard to do, didn't cost anything, and it's just a better stewardship of your resources, totally legitimate. Government's all fine with that arrangement, but you have to do this planning ahead of your passing. Okay, so another more recent thing that's come about is something called a charitable IRA rollover. Now, this doesn't have to do with death. This has to do with living for those of us that are age 70 and a half or older. That's a kind of a magic age. And if you're 70 and a half or older, you probably already know this, but you're forced to take some money out of your IRA every year, whether you want it or not. Now, if you don't take it, you don't have to. There's a 50% penalty for not taking the minimum amount required by law. It's usually a percentage. Okay, well, let's see. There's a new rule that says you can take your money from your IRA and roll it over directly to a charity, and there's some benefit in that, and that qualifies for your required minimum distribution. So here we've got Henry. He's got $100,000 in his IRA, just turned 70 and a half. And his required minimum distribution is $3,650. And he can send that directly to Hope Ministries from his IRA custodian, goes around his tax return, and they get the $3,650, and he does not get charged with any taxable income on that. Doesn't have to even deal with another tax return. Now you might say, well, what the big deal is that? If he just takes his $100,000 and takes his required minimum distribution out, and then turns around and puts his checkbook and then gives it to Hope Ministries, they still get the $3,650. He gets to deduct it, right? Maybe not, because under the new tax law, if he as a single person doesn't have itemized deductions exceeding $12,000, he doesn't get to itemize. Those deductions get doubled this year under the new tax law. If he's married, $24,000 is your standard deduction, and there's no itemization. Prior to the change in the tax law last year, 70% of the population didn't itemize their deductions anyway. It's guesstimated that since the tax law changed last year, 92% will not itemize. So for you non-itemizers, this charitable IRA rollover is a wonderful tool because he gets the benefit of moving that money to his favorite nonprofit, and he doesn't have to mess with the tax on it. And here's some additional benefits. He avoids the limitation on charitable deduction. He can receive a charitable tax benefit even though he doesn't itemize. It's just like he was able to deduct that, but he didn't have to deduct it because it was never recognized as income. It went directly from his IRA custodian to Hope Ministries. But here's another deal. That then lowered his adjusted gross income. That helped him reduce his Medicare Part B premiums that they take out of his Social Security check. And those get to be a big deal, folks, let me tell you. So there's a secondary benefit of a charitable IRA rollover. The same could be true as far as the taxable amount of his Social Security benefits. You know, there's 3 different thresholds as to where your taxable Social Security benefits are taxed based on your adjusted gross income. Well, if your IRA RMD doesn't add to your adjusted gross income, that helps you stay in that lower bracket. And it increases medical and miscellaneous deductions by lowering the deductible floors. I'm getting way deep into the tax code here. But it's just a wonderful thing for Henry to do that. Helped him a lot. So that's it. So the charitable IRA rollover is a good thing if you're over 70 and a half and really consider it. It's easy. It doesn't cost anything. You just have to take action before the end of the year to do it to get your RMD taken care of. There's another question, folks. How many of you receive regular checks from the nonprofits you support? I know you support them with regular checks going the other way, but are they sending you any money? Well, would you like to receive checks from your favorite nonprofits? You can do that through using one of the charitable instruments that are available. The most simple is called a charitable gift annuity. Simply a contract between you and a charity that provides for annual payments to you during your lifetime in exchange for your gift into this account of cash or securities or whatever you want to put in there. So it's a gift that gives back to you during your lifetime, and then you'll see at your passing, 100% of what's left in it goes to the nonprofit that helped you set that up. So it's kind of what's called a planned gift. To me, this is a great substitute for the will bequest that we talked about earlier, because you benefit from this during your lifetime. And I'll show you here in a minute how you benefit. Payments to you can be started immediately, or you can defer them if you don't need them quite yet. Either way, when you set this up, you get an immediate charitable tax deduction in addition to getting income back. This concept has been around for more than 160 years. The American Bible Society first issued a charitable gift annuity as a nonprofit back in the late 1800s. It's not new, yet most of the population doesn't even know it exists because nonprofits don't have a big marketing budget. So here's how this works. As a donor, you set up a charitable gift annuity. You see I've got that little blue umbrella over that account there. That means it's tax sheltered. IRS doesn't get at it. It's got a spigot on it. And so when you give cash, or even better, appreciated stocks, bonds, or real estate into your charitable gift annuity account, then it turns around, the spigot turns on and sends you and your spouse, if there's two of you, income for the rest of your life. You can't outlive it. You can live to 115. The income keeps coming. It's like a charitable pension plan. Then at your passing, 100% of whatever's left in an account goes to Hope Ministry as a planned gift legacy, just like a will bequest would have. But in this case, during life, you got a nice income stream, a nice tax deduction. In fact, your income stream is probably larger from this account than it will be from most of your investment accounts. So the income is fixed for your lifetime. You don't have to worry about what the stock market's doing. And besides that, you get a charitable income tax deduction up front, and I'll show you an example here in a minute what that is. And at your passing, whatever goes to Hope Ministry goes outside of the probate process, goes direct. So why would you even consider a gift annuity? Well, you might have heard of these things called charitable remainder trusts, which is kind of the same thing, but a lot more sophisticated. They're more costly. Takes legal expertise to put them together, cost to maintain them, and so on. Or you might have just smaller amounts to give. A trust usually requires $250,000 to $500,000 to justify them to make that much of a contribution. And charitable gift annuities, you can start those with as little as $20,000 deposit. And you'd like to, frankly, receive more income than you're receiving on some of the other fixed income investments. If you got money market accounts, savings accounts, CDs, paying you 1%, 2%, maybe 3% the most if you're lucky, you can often double or triple that using a charitable gift annuity. And the other thing is you can provide one of these as a benefit for someone else. Maybe your mother-in-law needs some more income to help her with her retirement home rent. Maybe your sister just lost her husband and needs some additional income. You can set this up for other people with the remainder still going to Hope Ministry, and you get the tax benefit. So what can you fund a charitable gift annuity with? Well, cash still works. You can write a check, but even better, you can fund it with appreciated securities, real estate, commodities, closely held stock, and there's some real tax avoidance benefits if you would fund a gift annuity with some of those animals. It's even better than cash, but I can't get into too much of that today because of time. And you might say, well, how much am I going to get paid out of this? Well, the rate of payments depending on your age when you set this up, and that rate is determined by the American Council on Gift Annuities, an independent body that most nonprofits subscribe to, and they have actuaries on staff that continually monitor what is an appropriate amount to put in these gift annuities as far as a payout rate that's going to be good for the charity and good for the donor. All I can tell you is that the older you are when you start this up, the larger the payments are. I'll show you an example of that in a minute. Payments to you can be quarterly, semi-annual, annually, depending on what you want. Here is an example of the current rates. These rates were in effect last July. So if you set up a gift annuity for Hope Ministry today and you're 70, you're going to get a 5.6% payout rate. If you're 80, 7.3. And if you're like my mother, who's 92, she's going to get 9.9%. That's pretty cool. That's pretty good. Probably better than what you're getting on the bank deposits. If you want to see the rates in particular, you can go to www.acga-web.org. That's the American Council on Gift Annuities. And you can find your particular age, and if you have two of you, it's a little different, etc. Isn't that amazing? So here are the benefits to you as a donor during your life of a CGA. You get a partial income tax deduction based on the value of the gift when you start. And the income you receive out of this animal is partially tax-free. That's even better. And at your death, whatever's left gets paid outside your estate, going directly to the favorite charities, including Hope Ministry. So the advantages and disadvantages to this instrument. The advantages are pretty lengthy. You get an initial income tax deduction. You have a guaranteed fixed income for life. It's not going to be affected by the stock market. Partially tax-free income, and leaving a lasting impact to your community. Now, the disadvantage would be these are fixed. There's no flexibility. You cannot change the income once you start. The only thing you can do is discontinue payments yourself and let the Hope Ministries have it before you die. That's about the only thing that you can change. Everything else is fixed in cement. But here's what a charitable gift annuity is not. It is not a commercial annuity issued by an insurance company. And of course, Des Moines has a few insurance companies. That doesn't make them bad necessarily, but here's how it works. With a commercial annuity, you can set up, get the same kind of an income stream, but you get no charitable income tax deduction for doing it. And at your passing, whatever's left in that bucket stays with the insurance company, as opposed to going to Hope Ministries. So you can just see that a charitable gift annuity can have some wonderful advantages over an insurance company annuity. Here's an example of Mary Jones. She's 75, and her husband just passed away, and she wants a little more income, and she got $50,000 from the life insurance policy. Didn't know what to do with it. So we recommended that she consider putting a CGA. So she puts $50,000 into a CGA, and when she does that year, she gets a charitable income tax deduction equal to $22,877. That's the actuarial calculation on the government table that says that's what she gets to deduct this year, even though Hope Ministries doesn't get that money until she passes away. And when she passes away, we guesstimate that if she dies on time, according to her life expectancy, about half of what she put in will be left for the charity. Because during her lifetime, she's taken out principal and interest and corpus from the annuity to give her 6.2% payment. That's how these are set up. So she'd get $3,100 a year out of this $50,000 annuity, which is 6.2%. But get this, $2,188 of it is tax-free. So effectively, it's like she got 8.27% on an after-tax basis. That's hard to beat. And then, of course, she gets to leave a legacy to Hope Ministries after her passing. They're going to receive whatever's left in that account. If she dies early, there'll be more than half. If she dies after her life expectancy, there'll be less. So what else could Mary have done with $50,000 in cash? Well, she could have put it in 1% savings account, paid tax on the interest, and spend $390 a year. Whoopie-ding. Or she could have a 2% deposit, certificate deposit. Isn't that wonderful? And get to spend $780 a year. Or she could put it in a charitable gift annuity to benefit Hope Ministry, get $3,100 a year, of which $2,188 is tax-free, have $2,800 of spendable income, and have a $22,000 charitable deduction the first year to boot. Pretty good for Mary. She loved it. I've done this for several ladies in my church. They think I'm a pretty good guy. All I did was tell them how it worked, and they wanted to benefit the church and themselves. Done. Now, Mary has a younger sister who's 55 that heard Mary talking about this, but really, Susan's still working, and she's not retired. And so, but she said, can I set one of these up? I said, yep, you can do that, but we're going to defer your payments until you're Mary's age 20 years from now. So you put your $50,000 into a deferred payment gift annuity. You're going to do a deduction even a little larger than Mary got, almost $29,000. And then 20 years from now, in 2038, you're going to get $6,400 a year because you let the account grow, of which $1,600 will be tax-free. And then at your passing, about half is still going to go to your favorite nonprofits, including Hope Ministries. So it even works for younger people. If you don't need the money now, but you want to have a place to put the deposit, and then if you happen to die, then it still goes to the charity in the event of your death, kind of like a will bequest. I don't think we're out of time today. Boy, this has gone a little faster than I thought. Time flies and having fun. If you go to our website, Charitable Giving Resource Center, you can go to magnifyyouриmpact.com. And on the home page, it looks just like this. And if you click on that little green button that says Charitable Gift Calculator, it'll bring up this Gift Illustrator program. And if you click on the left tab there, it says Gifts that Supply You Income. You can actually put in your age and dollar amount, and they'll show you immediately what you get for income, what the tax deduction would be, etc. It's a really cool thing. It's free. So if you want to play with that, be my guest. So in Proverbs 3:6, it says, in everything you do, put God first, and guess what? He will then direct you and crown your efforts with success. So proper planning for yourself and your family and your favorite Christian nonprofits is a wonderful thing to do. It follows the biblical mandate. And you know what Proverbs says? You do things right, you get success, and you get crowns. So here's the big question you need to ask yourself. How do you want to be remembered? If you plant an acorn today, it can grow into a tall oak tree tomorrow. Well, here'd be some next steps if you want to leave a lasting legacy. First, you need to talk to your professional advisors about either creating a will bequest or changing your beneficiary designations to include Hope Ministries and others in your IRA accounts, your life insurance. Or if you want to talk more about these charitable gift annuities that we just described here, you can talk to Sue at Hope Ministries. She'd be happy to talk to you about how that gets set up. And if you do any of these, please inform Sue at Hope Ministries about your intentions. They just love to know that you've included Hope Ministries in your plans. You don't have to tell them how much or what it was. They would just like to honor you as being part of a lasting legacy for Hope Ministries. So with that, we'll see if we have any questions here. I'll open up my little question box. Where'd my question box go? Can't find my question box. Okay, I'm going to shut that down. Here. I hope we don't have any questions because I can't find the question box. Where did it go? I'm going to shut that down. I take this off. Okay. I don't know where my question box went. Oh, I apologize, folks. This is awful because I wanted to answer all your questions. I have no idea what happened to the question box. There's a chat box. Go ahead and type in a message and we'll chat. We've got about 4 or 5 minutes left before the end. I'd just be interested in hearing from those that are on the call today if there's anything that really triggered some excitement in you, or just what was the best thing you heard today.
If we don't have any questions coming in, I know that we get questions from
Okay.
At Hope Ministries. And for example, we hear this question: what is your opinion about a person writing their own will? For example, using LegalZoom.
Oh, well, my opinion about writing your own will is not very good because they can be ripped apart in court by a disgruntled heir. And LegalZoom is kind of a do-it-yourself way of doing that, just done on the internet. But again, you know, they're not representing you. They're not going to represent you in court. I just don't have a high degree of confidence in doing that yourself. It's too important. You know, would you do your own brain surgery? Probably not. So I'd always recommend getting a qualified estate attorney, and I'm sure Hope Ministry has a list of several if you don't have one that can help you do that. It's well worth the money that you spend to create a lasting legacy and avoid disharmony in your family after you're gone.
Another one comment is, gee, you know, I've heard that getting a will done is very expensive.
Oh, yeah, I think, you know, when you start talking to attorneys, you think big fees and so on. And because we're not an attorney, but we see a lot of these fees come through when we send our clients to get these instruments drafted. I've seen wills drafted for as little as $500 and as much as $5,000. So there's a big range. Generally, we're finding they're in about $800 to $1,500, depending on your circumstance. That would be my guess. Great investment.
Okay.
What other questions might you ever get asked? Any?
Well, we often get asked, what happens if I don't have a will? And I know you had a slide that covered that, but sometimes it's just good to go over that again.
The state of Iowa is going to say, here's who gets it. Good luck. It's pretty important to have a will, even if you don't have a lot of resources, especially if you have minor children at home. You need to name those guardians.
Yeah. And maybe one more. If I have a will already, how often should I update it?
Oh, yeah, that's a good question, because what the lawyers usually tell people is you need to have it reviewed every 5 years. We have clients come to us, they haven't looked at them for 20. We recommend you probably look at it every couple of years, but you need someone to precipitate that. And usually the lawyers feel a little uncomfortable calling you up and say, you want your will reviewed. They're kind of afraid that they're being too pushy. Or I would say at least every 5, unless you had a change in your life circumstances. There's a death in the family or remarriage or anything going on that's unusual, sale of a business, you need to make sure your will ties into your new circumstance. When you have a change in circumstance, that's an important time to look at your wills or your living trust. Okay. Is that good?
Yeah. Well, this concludes our webinar on wills. And on behalf of Hope Ministries, thank you for attending. I'd like to thank John Syverson again for providing his time and expertise as a service to our donors and friends of our ministry. And as John talked about, we invite you to contact me at Hope Ministries if you have questions, or if you'd like to request our wills guide or other information on estate and legacy planning. You can contact us at 515-265-7272 or visit our website at www.hopeiowa.org and click on the Legacy Planning tab. Thanks again for attending.